Okay, this is going to be the last lesson of chapter 2. In chapter 2, let's have a quick recap of what we've learned, right? We've learned all the price arrays that we can expect price to trade to, react off of, we can base trade ideas off of them. Rejection block, order block, breaker block, mitigation block, liquidity void, fair value gap. Am I missing any? I don't think I'm missing any. Now, how do we use this, right, to form bias is one thing. I haven't introduced you to something yet, and this is the key concept. This is going to be the backbone of your trading, the backbone of everything when you're trying to participate within the market. Premium, discount, array, matrix, right? Every single price range, we want to view it as a premium and discount. Notice the time frame I'm on, the monthly. Of course, it works amongst all time frames. However, we want to use higher time frames to base our biases off of. So I'm using the monthly one. Before this range created, because this range has, this hasn't topped yet. So we're considering this one to this one. And all I've done on my fib is have the 1, the 0, and halfway 0.5. Halfway, we label that equilibrium, right? Or some, you might see some other traders, they call it balance. This is equilibrium of this price range. And you see how when we go above it, small rejection will come into it. We're going to go into the reason why. But right now, let's talk about the matrix. So whenever you see a price range, right, have you not realized something? And I've tried to push some of you guys in private messages when you guys ask me, especially about the rejection blocks. You guys have tried to show me rejection blocks. For example, like here, like is this rejection block or whatever? And I say no. And I tell you, rejection blocks, they form in specific areas within a price range, either the extreme high or the low. And it makes sense, right? It makes sense. And all the other price arrays, they have a order at which you will see them come. In a price range, there is an order of them. So let's say in a premium, you're trading into a premium now. You're trading above the 50%, right? You're trading above the 50%. The first thing you're likely to bump into in above the 50% is a mitigation block or breaker block, right? Then it's going to probably be a liquidity void, fair value gap, then an order block, a rejection block, and then ultimately, if you trade past all of that, the last thing left is the high of the range. Now, notice how I didn't say all of them exist within a range. If one of them is absent, you go to the next one. Now, I'm gonna write it out for you guys. Bear with me, because I usually go from the bottom up. This is me doing it because I have to go from the top down. You see, then it's gonna be value gap. Let's call this Example, TR. So minus VE just means negative. If you didn't know that, it's if you do maths or like a maths or even at A level, you'll know that minus VE means negative. It's just a short it's an abbreviation for negative, right? So let's keep that here, and then let's do another one. So minus VE is negative, plus VE must be positive, right? Let's keep doing fog. Actually, let's add to this. This is for discount, right? You see how they're the inverse, and in between here. So let's just get a trend line. Let's label this fair value 50%. So this is your price range, right? Let's say you have a price range like this. Right? This is your price range. And here is going to be the 50%. As you transition from a discount to a premium and you come up, and I'm going to show you a live example on the same DXY chart that one. The first thing that you want to check for if let's say all of these are going to be here, hypothetically, the first thing that will lead to some sort of resistance that you should, you know, that can form short trade ideas or one where you want to take profit on your longs from the discount. Is there a mitigation block? If there is, you know that's going to offer an obstacle, take profit from there. If there's no mitigation block, there might be a breaker block. If none of these are here, then you just go to the next one. And if none of the and if they keep being absent meaning like none of them are here, then you keep going, keep going. One of them are going to be there, 100 million%, right? Most of the time, a few of these are here. It's rare to find a range with all of them, right? Maybe one of you can do a homework and show me a range of all of them. But the point being is, this is the order that these price arrays form in within price ranges. And I, if you see weekly commentary 10, watch the start of weekly commentary 10 again. How I talk about the DXY on the weekly chart. We deal with what's in front of us step at a time. We don't just jump to the old high. You got to consider the order block that comes before it, and the rejection block, and the mitigation block, right? It's the same. Applies to the discount. If you're trading from the premium, you're shorting from a premium to a discount. You want to look for where you can take a profit, or where you want to offer, a long idea, mitigation block. If that's not there, the breaker block. If that's not there, this, then this, then this, then this, then this. Now, let's apply it to a chart. Let's see if you guys can see it. Everything above the 50% is deemed a premium price. Everything below the 50% is deemed a discount price. Now, we came back into the discount, right? We created here. This is a discount price, right? We're moving higher. We're moving higher. We see here, right? You see when we came up here, break this high, and creating the gap, the fair value gap when we done it. This candle didn't create a fair value gap, but then we broke this high and create a fair value gap. So it's likely we're going to start trading towards what? A premium. So you want to find the range that you're in, this high from the past to this high, where we start making the move higher. Split the range into 50%. Now you want to look at the 50%. Now let's look at it. What's the first thing that's in the 50%? What's this candle? For your studies, is this a mitigation or is this a breaker? High, low, higher high, lower low. This is your breaker block. And look, as soon as we get up above the 50%, what happens? We're met with breaker block. Okay. Oh, breaker block's the second one. And then what is there? So let's remove this. This is what I taught you guys as a fair value gap. It was called fog. Let me change that because it always changes itself to fog when you make because of the spell check. So we had the breaker, the fair value gap, and you see how they're one after the other. The liquidity void is absent, so we skip over it and we look for the fair value gap. Is there a fair value gap? Yes. If there was no fair value gap, then we'll look for the order block. Do you see what I'm saying? We There's an absence of liquidity void within that price range, so we look for the fair value gap. And what happens next? The fair value gap is there. And then order block, the last down close candle. This is one entire order block. That's right. But if you go scale it to the weekly, if you scale it down into the weekly, you see how you have the fair value gap and you have the order block, right? You have this weekly order block here, these two candles. And then what do you expect above the order block? You expect the rejection block, and then there's going to be the old high. And it's the most logical way to go about it. Why? Because the rejection block is always going to be at the very high. There's nothing that you can, no price array can be above the rejection block because of the nature of it. How did I teach you guys a rejection block? It's the high or the low, right? With the wick that we like to see it take out, highs or lows, liquidity, right? And then a rejection off of it. So how can you have that in the middle of the range? Because it's within the high, right? It can't be within the range because specifically it's within the high. And then ultimately above the rejection block, right, at the top of the rejection block is the high of the range. This is the order. One second, let me go to the daily chart for you guys. This is the order that you'll see price trade at. Now, every single time you come up against one of these price arrays, when we come up to the breaker block, what happened? Right? We come back down towards the 50%. When we come back down into the 50%, you have to do the same thing because price isn't just going to go anywhere in the 50%. It's going to go back to one of the price arrays in the 50%. So what is the first price array you're faced with when you come back into the discount? Underneath the discount, what's the first thing that we see? You see the liquidity void, right? I mean, not the liquidity void, the fair value gap. From here to here. This one candle goes into it and comes down. And then what happens? This offers a new long idea coming back into the discount. Then we trade into the fair value gap just here. And then what happens? We trade into this candle's wick, which is what? If we go down into the daily, this was, let me go back to the monthly and highlight that. Look above here at the 50%. This is the 50% line. Accumulation. When you're at the 50%, especially on the higher time frames, you'll see there is always some sort of quick back and forth at the 50%. Price doesn't stay at the 50% for a very long time because the algorithm, this is how the algorithm defines what's expensive and what's cheap, premium and discount pricing. But you always hear the same: buy low and sell high. But relative to what? Whose definitions are we using for what's deemed expensive and what's deemed cheap? Are we using retail, RSI, overbought, oversold? Are we going with that school of thought? Are we going with, someone might have made their own thing up, saying I only sell, I don't know, only anything below the 90 for the DXY is, cheap. Anything above 100 is expensive. They might deem it like that. But are they correct? Did they make the market? Do they Did they offer any movement into the market? No. You want to look at it through the lens of an algorithm. And the algorithm will view it like this. 50% is deemed fair value. Anything above 50% is a premium. Anything below 50% is a discount price. Every single time you traded into a premium array, what did it offer? It offered a rejection for accumulation under the 50%, and then we trade again higher, and then we've traded higher. So if I remove this, remove these lines as well. We break this range, right? And then we start to, we create a high and we come down. What would you do? This is what you'll do. You go from the low to whatever high this is. Let's say it makes its high over here and it does a retracement. Every single time you're coming down, there is going to be long positions in the 50 on in the bottom half, the bottom quadrant of the 50% of the fib. In the discount zone is where you want to buy. Up here, if it tops, you only want to look for short ideas to form, right? And until you get to the 50%. Now, this is a monthly. You can apply the same thing, of course, to all the time frames, right? So let's find the price range. Um, this low, and we can all agree that this candle was a high, right? Just move this so that the 50% is out of the way of the price action. Cool. From this low to this high, when we trade above it, look at what's exactly the first thing coming above the 50%. It's the imbalance that the 50% is on, right? The fair value gap. And when we trade into this fair value gap, what do we expect to happen? A retracement back underneath the 50% into a discount to accumulate long orders to go higher, and we break the range. And it's the same thing, right? There's a fair value gap, right? There's an order block and then the old high. No rejection block in here. But you see how the order block is lower than the fair is always is higher than the fair value gap. And think back to what I told you makes a high probability order block. If the order block, what comes after the order block, that makes a high probability. The fair value gap. It's not the fair value gap that comes before that makes the order block high probability. No, it's the fair value gap that reinforces that there's been a true change in the state of delivery shown by the order block, which is what makes an order block an order block. Do you see how they come in a specific array, right? And now, if all of them exist, right? Let's say go back to the hierarchy. If all of these exist and you trade from a discount into a premium, and the first thing you see is a mitigation block, and you see the breakout, and you see all of these, you need to consider the mitigation block first. There's either going to be a mitigation or breaker. If it's a failure swing and then it breaks lower, it's going to be mitigation. If it goes higher then lower low, it's going to be your breaker. That's why it could be either one of these two. You won't see them both together, right? If when you come out of the discount, the first thing you see is a mitigation block, you want to consider that mitigation block. If it's when you're coming out of the discount, because this is what people don't understand. They see, but the order block got traded to. Why is that? Well, was it the environment of going from a discount to the premium, or were you already in a premium and you're trying to get to a discount? If it was you're already at the 50% and you're trading above it, and the first thing is a mitigation block and there's an order block above it, it's going to trade to the mitigation block. It will trade to the mitigation block. It will reject off of it. It doesn't mean it's going to go to the mitigation block and then completely change the trend. The mitigation block is going to offer resistance. It will not just trade through the entire mitigation block, right? I'm sure in Bitcoin, this is what happened on Bitcoin. What's this? Let's go on. I think it's on the weekly chart. That was weekly. Yeah. We come up. What happens? When we come down here, what's this? Institutional order flow entry drill, right? This wick slightly higher than this, fills this imbalance, and we move down. Now, we rejected off here, and we haven't moved back to a premium, showing what price wants to stay in a discount. If it's staying in a discount, whilst the DXY is of course seeking premium prices above the rejection, it's now broken the high, right? What to look for Bitcoin, right? You want to see how we're going to trade into this, because we haven't traded into the rejection block yet. We've traded into the order block, found support. This is a what? What did I say? Did I say that we trade into these arrays and then we completely reverse and go the opposite way? We accumulate orders, right? It hasn't gone into the premium, fair enough. It was very close to going back into the premium. It's accumulating orders, in my opinion, for another a great short. That's my take on Bitcoin. But you want to see how it first comes into the rejection block, right? You want to see how it comes into the rejection block and ultimately the old low. Just like how on the DXY, we wanted to trade above these highs into the rejection block and then above the old highs. But this week, look at the move. It done it all in one go. Why is this important? Because when you're framing your trades on the intraday level and you're already in a price range, so for example, you're from here to here, you need to know where you are, right? I know you guys consider the OTE, but consider it now as this. 50%, we come down here. When it's coming down here, you don't want to be short again. Like this, okay, you see this candle? Let's say this is a daily. On the next day, it's fair enough. You can assume that you're making a move back to equilibrium of this price range. So you can be a short seller from here to the 50%. Anything under the 50%, you don't want to hold a trade past that. You don't want to hold a trade past that, right? Especially if it's counter trend. If it's counter trend and it's gone back and retraced back to the 50%, you want to take profit, right? Because at the 50%, what does the price range become? A discount. And what's favorable in a discount? Long positions, not short positions. What was the first thing that we saw here? What is in this price range, right? Well, we got an order block and we got a fair value gap, which shows that this is a what? This is a true order block. So if we actually remove this and bring out this down close candle in real time, beneath an old low into this is into a order block with the fair value gap showing this is a true order block. You got sell side liquidity here. This is not part of the video. This is just being analytic of the price action. Couple it. I think there's a news event tomorrow. This is an area you expect price to trade back into this consolidation to reaccumulate long and send it higher. Now that you have your premium and discounts, and now that chapter 2 is officially over, right? I want you guys to do this homework. Go onto the daily chart. Go onto the daily chart. Actually, not the daily, because it's just one way up. Let's go on a weekly. What I want you guys to do is from this low to this high, I want you guys to annotate every price array. Every single price array, I want you guys now to annotate charts. That's what I want you guys to do. On the higher time frame, I'm giving you guys this homework on the weekly. I want you guys to annotate the charts. So I'll give you an example, right? This will be a fair value gap. This will be an order block, right? This is a mitigation block. That's how I want you guys to now chart. That's how I want you guys to chart up now. Because what this is going to do on the higher time frame is going to give you guys the reference points to price where to expect your retracements to end and also targets. Having your charts on the weekly especially the weekly and the daily, is so important. A lot of us we get lost on the on the lower time frames, and a lot of us, one of the hardest part of trading, in my honest opinion, is waiting for that higher time frame correction, waiting for price to be at your price array on the higher time frame. Because right now there is nothing really on the higher time frame here. We've kind of we've taken out these highs, right? We're trading above these highs today. Is Let's see if this is going to be a false move up and move lower. You have to see how the week ends, right? I don't think that this is it. I think we'll definitely go towards the maybe the 104 or 103.80 is where I first want to see price trade to. But the weekly time frame breaking a high, I think anyone that's shorting the DXY here will be punished. I'm assuming the DXY is going to punch through this aggressively, drowning every single short seller here. Because when this is short from here and you're punching above the DXY to 104, those people are severely under the water. They need to close, they're going to be forced to close positions out. Stop loss is triggered, the whole lot. But that's it for this video. You guys would want to take a screenshot of this, right? And make sense of it logically. Okay, don't do like that. Make sense of it logically. Does it make sense for the rejection block to be the first thing at the bottom of the price range? No. Think of the characteristics of it. Like how I explained in the video, does it make sense for the fair value gap to come before the order block? No, it doesn't. Does it make sense for the liquidity void to come before the fair value gap? No, because the liquidity void makes the fair value gap high probability, and the fair value gap makes the order block high probability. So that's why it's in this order. Now the mitigation block and the breaker block, well, when their formations happen, right? If it's a bearish market and then there's a move up, a retracement up, but that retracement up doesn't break the previous high and then you break lower, it's a mitigation block. But if it breaks the high and then breaks the low, it's a breaker block. That's why you have one of the two. But these three especially is always this order. You will not find in any other order. You will not find when all of these exist, you won't find the order block coming after the fair value gap. And it's the same for here. So always be conscious of 50% of the range and play around with it. Go on another pair, right? Go on another pair, test it out. Go on the monthly or the weekly, find a price range, a clear, discernible price range like this one that I showed you. Have the fib like mine, 50%, and see how price reacts around the 50% of it. Does it move in and out of the 50%? When you hit a premium array, is there a retracement back lower to the 50%? Now, when we are deep into the premium, of course, it's illogical to think that it's going to come back deep into here and then go here and then deep back into it and then here. It's when we first come into it, you have to apply some logic to it, right? When you come up to, when we came up to this, you expect it to retrace back. As we're already close to the 50%, you expect it to retrace back into the 50% into a discount array and then move higher. Now, when we're, rejecting off the rejection block, we wouldn't want to see it trade all the way back into the discount and then higher. You want to see a fair retracement back because there's still, remember, this is one price range, right, from here to here. But with along the way, there's more price range, and this is where you can, come flustered. This is the external range liquidity that we're working with, right, from here to here. That's our external range. Within this external range, from this high to this low, there's internal range liquidity, right? You can have your fib also anchored, right? So when we trade into the premium, like here, we traded into this premium, this order block, you can have your fib like this, Okay, let's use this low. You can have your fib here, and it can come to the 50% of this internal price range, and then go higher. Our main reference point for the price, for the significant price arrays though, are within the external range, because that's what we're doing. And remember, we will always remove within the external range, yeah, moving from the premium and discount of an external range, internal highs and internal lows within, because this is a bullish impulse upwards, we expect short-term internal lows to be swept. So for example, this got swept by this to fund larger moves higher until we take out here. Now this is, a key zone for the DXY. If we go on the monthly, someone, I think it was Harvey, he said that we're trading within these rejection blocks. So why I said 103.80 is because 103.80 is a institutional reference point in price, right? And it's very close to the top of this high. There's one day, well, it's going to be less than a day after this is going to be probably seen by the majority of you for the DXY. And then we're going into May, and June caps the quarter. So it'll be very interesting to see how we start trading in the first half of May and May as a general in the month. There's been a lot in this video, and I know some people are going to be confused, and the whole, the matrix is going to throw them off maybe, but it's crucial that you split your external ranges into the upper, the lower, and the 50% so that you know if you're trading in a premium or a discount. If you don't know you're trading in a premium or discount, you do not know if longs or shorts are favorable in the marketplace you're at. And you won't know which direction the market is truly going towards, right? That's all for this video. I'm going to expect a lot of questions for this one. Do the homework. Please do the homework. The homework on the weekly chart for this low to this high, I want you guys to annotate it with all the price arrays I've taught you. I've taught them all. There's nothing in here I haven't taught you guys. Screenshot it, preferably from your computer if you can. On the phone is just quite difficult. And send it to me. And if you want, find it and do this across many pairs. Just find any pair and do it for me. So for example, AUD, USD from this high to this low, right? I want you can show me everything in this price range. So for example, there was this fair value gap from here to here, right? There was this mitigation block. This is an order block, right? This is an order block. Things like that. I want you guys to show me. This is a rejection block. Rejection block. Fair value gap. I want you guys to start annotating your charts and start really practicing the price arrays. There's no way to get better without practicing. I remember when I was at this stage of my trading journey and I was just annotating charts and I was asking people that were in the charted group and I was asking them if this is good, if what I can do better, and I was getting it wrong. I used to really not understand rejection blocks, right? And I used to kind of struggle with um, fair value gap, and they used to explain it to me, and I used to get it wrong. I used to get it wrong. And then I would get advice of why I'm wrong. I go apply that advice, and I get it right, and now I know what to look for. That's called the learning process. Getting it wrong, being advised why you're wrong, rectifying your mistake, and then going and doing the right thing. So let's end the video there. Any questions? Messages are always open. Now, I'm going to make a Word document and it's going to contain everything in chapter 2. But you guys need to give me some time to make it. It's come to the end of Ramadan for me. It's quite busy. It's going to be Eid, so the next week's going to be hectic. I'm going to try my best to get that Word document done for you guys ASAP before moving on to chapter 3 intraday teachings. So until next time, and take care of yourselves, guys.